IRS New Penalty 2026. Senior homeowners must act before August 15th. If you own a home and you are over the age of 60, the next few minutes could either save you thousands of dollars or cost you thousands if you walk away without taking action. And that is not an exaggeration. What is unfolding in 2026 is one of the most significant shifts in IRS enforcement that senior homeowners have faced in recent memory. The IRS has rolled out a new penalty structure quietly, without a press conference, without a headline on the evening news, and it is landing directly on the doorsteps of older Americans who own homes, who have equity, and who had absolutely no idea they were doing anything wrong. The deadline to act is August 15th, not approximately August 15th, not sometime before the end of summer. August 15th is the hard cutoff, and what happens after that date is entirely out of your hands once it passes. So, stay with me through this entire video. By the time we are done, you are going to understand exactly what this penalty is, exactly who it is targeting and why, and exactly what steps you need to take right now to protect yourself before that deadline arrives. And if you are watching this and you have a parent, a grandparent, a neighbor, anyone over 60 who owns a home, please share this with them today. Not tomorrow, today, because the people who need this information the most are often the last ones to find it. Let us start at the foundation, because understanding why this is happening is what makes everything else make sense. For generations, owning a home in America has been treated as one of the most tax-advantaged financial positions a person can hold. You buy a home, you live in it, you build equity over time, and the tax code has traditionally provided significant protections when you eventually sell, transfer, or pass that home to your family. That was the foundation of the American homeownership promise, and for most of the last several decades, it held. But here is what changed. Home values across the United States have appreciated at a pace that nobody fully anticipated. Homes that were worth $150,000 15 years ago are now worth $400,000 and $500,000 in many parts of the country. Some markets saw even more dramatic increases. And while that appreciation feels like good news, and in many ways it is, it also means that financial transactions that used to fly under the radar because the dollar amounts were modest are now triggering significant tax consequences because the numbers have become so large. The IRS noticed, and in 2026, they acted. What we are specifically talking about is an enforcement expansion targeting what the IRS is calling unreported home equity events. I am going to explain exactly what that phrase means in plain English, but first understand the scale of what is happening. The IRS has been building a data infrastructure over the last several years that allows them to cross-reference county property records, mortgage and home equity loan data, deed transfer records, short-term rental income reports from major rental platforms, and estate and inheritance filings, all against the actual tax returns filed by American homeowners. They are using artificial intelligence and automated matching systems to identify gaps, and the demographic being flagged most consistently right now is senior homeowners, people over 60, because this group has had more of these triggering events occur in recent years and has been the least likely to know that those events required specific IRS reporting. So what are these triggering events? Let me walk you through the most common ones, because there is a very real chance that at least one of them applies to you or to someone you know. The first triggering event is a home equity loan or line of credit used for purposes other than home improvement. Over the last several years, with inflation driving up the cost of everything and credit card interest rates hitting historic highs, millions of seniors turned to their home equity as a source of accessible cash. Maybe you needed to cover medical expenses. Maybe you helped an adult child or grandchild with a down payment or tuition. Maybe you consolidated debt. Those are all completely reasonable financial decisions. But here is what most people were never told at the time. The tax treatment of home equity loan interest depends entirely on how the money was used. If the funds were used for something other than buying, building, or substantially improving the home that secures the loan, the interest is not deductible. And if that interest was claimed as a deduction on your tax returns, when it should not have been, you now have an unreported compliance issue that the IRS is actively identifying. The penalty structure for this starts at $500 and scales up based on the amount improperly deducted. The second triggering event is a partial property transfer, and this one catches more people off guard than almost anything else on this list. At some point in the last few years, did you add an adult child to your home's deed? Maybe you did it to avoid probate. Maybe someone advised you it would protect the home from Medicaid. Maybe you simply wanted to make sure your family would not have to deal with a complicated legal process when you were gone. Every one of those motivations makes complete sense. But here is what most people did not know when they made that deed change. Adding someone to a property deed is treated by the IRS as a gift of real estate. And gifts of real estate above a certain value, specifically above the annual gift tax exclusion of $18,000 per recipient in 2026, require the filing of Form 709, the gift tax return. If your home is worth $400,000 and you gave your child a 50% interest in the property, you transferred $200,000 of value. Form 709 should have been filed for that year. If it was not, you now have an unreported gift event on record. And the IRS's property record matching systems are finding these situations by the thousands right now. The third triggering event is rental income from your primary residence. This has become increasingly common among seniors, and the reasons are completely understandable. You have a spare bedroom, you have a finished basement, the children have moved out, and the house is larger than you need. Online rental platforms have made it easy to earn meaningful supplemental income from unused space. And on a fixed income, that extra money can make a real difference. But the moment you start receiving rental income from your primary residence, you have converted part of that home from personal use to income-producing use in the eyes of the IRS. That conversion triggers a set of reporting requirements. You need to report the income on Schedule E. You need to properly allocate expenses between personal and rental use. You need to account for depreciation on the rental portion of the property. And here is where it gets particularly complicated for seniors. That depreciation affects your cost basis in the home, which directly affects how much taxable gain you have when you eventually sell. Major rental platforms are now legally required to report annual payments above $600 directly to the IRS on a 1099-K. So if you have been renting out part of your home and not reporting that income, the IRS already has the data. They are simply waiting for the matching process to be completed. The fourth triggering event is the inherited property trap. This one is especially painful because it involves people who were already dealing with grief and loss when the event occurred. If you inherited a property, a spouse's share of your home, a vacation cabin from a sibling, land from a parent, in the last several years there are specific documentation requirements that govern how the value of that property is established at the time of inheritance. This is what the tax code calls the stepped-up basis. When you inherit property, your basis for future tax purposes is generally the fair market value at the date of death, not what the original owner paid for it decades ago. That stepped-up basis is one of the most valuable provisions in the entire tax code for inheritors. But it only works if it is properly documented. If the estate did not file the appropriate forms establishing fair market value at the time of inheritance, you may be holding a property with an undocumented basis. And under the 2026 enforcement expansion, the IRS is now flagging these basis documentation failures and issuing penalties for the failure to establish and report proper basis records. Now let me address the question that is on most people's minds at this point. How would the IRS even know about any of this? The answer to that question is what makes 2026 genuinely different from everything that came before it. For most of tax history, the IRS caught compliance issues through audits, a relatively labor-intensive process where agents manually reviewed returns and cross-referenced records. Audit rates were low, enforcement was uneven, and a significant number of unreported home equity events simply slipped through. That era is over. The IRS now has automated data sharing agreements with county recorder offices in the majority of states, which means every deed transfer, every title change, every recorded lien is flowing into their systems in near real time. They receive data from mortgage servicers and home equity lenders. They receive 1099-K data from short-term rental platforms. They receive estate and inheritance filings. And they have built machine learning systems that compare all of this incoming data against filed tax returns, looking for gaps, mismatches, and omissions at a scale and speed that simply was not possible 5 years ago. By the time you receive a penalty notice in your mailbox, the IRS's system has already completed its analysis. The letter is not the beginning of their investigation, it is the conclusion of it. And that means waiting to see if a letter arrives is a losing strategy in the current environment. You need to be proactive. And that brings us directly to August 15th and why that specific date matters so much. The IRS has a current policy in effect for 2026, specifically for this enforcement expansion, that includes a voluntary compliance window for senior homeowners. If you identify issues with your past reporting and come into compliance before August 15th, you are eligible for first-time penalty abatement consideration and good faith compliance credit. In plain English, if you voluntarily fix your mistakes before the deadline, the IRS has the discretion to significantly reduce, or in some cases, eliminate the penalties associated with those mistakes entirely. This is a meaningful concession, and it is time-limited. After August 15th, the voluntary compliance window closes. Penalties that were not resolved become final assessments. Your options for disputing or reducing them become significantly more limited and significantly more expensive. So let me tell you specifically what you need to do, not in vague general terms, concrete steps. The first step is to gather your home-related financial documents going back to 2022. You need your original purchase documents, your closing disclosure or HUD-1 settlement statement showing what you originally paid for the home. You need records of any major improvements made to the property over the years. A new roof, a kitchen renovation, an added bathroom, a finished basement. These all increase your cost basis in the home and reduce your taxable gain when you eventually sell. Many seniors have made significant improvements over the years but kept no records, and that oversight is costing them money. You need any home equity loan or HELOC statements, including the loan agreement showing the stated purpose of the loan. You need any deed or title documents showing transfers or changes in ownership in the last 4 years. And if you have been renting out any portion of your home, you need records of income received and expenses incurred. The second step is to do a simple side-by-side comparison of those documents against your last 3 tax returns. You do not need to be a tax expert to do this. You are looking for obvious mismatches. Did you take out a HELOC, but there is nothing on your return addressing the interest deductibility? Did you add someone to your deed, but there is no Form 709 in your records? Did you receive rental income, but there is no Schedule E on your return? Are there deed transfers in the property records that were not accompanied by any kind of tax filing? You are simply inventorying the gaps at this stage. Making a list. Identifying what may need to be addressed. The third step is to take that inventory to a tax professional, and be specific about what kind of professional you need. You want a certified public accountant or an enrolled agent, which is someone who has passed a rigorous IRS examination and is specifically authorized to represent taxpayers before the IRS. You want someone with experience in real estate taxation, not a general preparer, not the person who has been filing your basic return for years without looking deeper. Someone who specifically understands home equity taxation, property transfers, and IRS penalty procedures. If you do not know how to find one, the National Association of Enrolled Agents has a directory on their website where you can search by location and specialty. The American Institute of CPAs has a similar resource. When you call, ask specifically whether they have experience with IRS penalty abatement for real estate-related issues. That one question will quickly tell you whether you have the right person. The fourth step is to check your IRS account transcript online. Every American taxpayer can create a free account at irs.gov and access their official tax transcripts, see what returns have been processed, see what notices or assessments are already on file, and see what third-party data the IRS has received and matched to their Social Security number. This is an incredibly powerful tool, and most people have no idea it exists. Setting up an account takes approximately 15 minutes. Once you are in, your transcript will show you exactly where you stand. If there are already pending notices or assessments related to your home, you will see them there. If the IRS has received 1099-K data from a rental platform that you did not report, you will see that on your transcript. Knowledge is everything when it comes to the IRS, and this tool gives you that knowledge directly from the source. The fifth step, and this is critically important, is to respond to any IRS notices you have already received. If you have gotten a letter in the last several months that you set aside because it felt confusing or overwhelming, pick it up right now. Look at the notice number in the upper right corner. Common notices related to home equity and property issues include CP 2000, which is an automated underreporter notice generated when the IRS's systems find income that was reported to them by a third party but not reported on your return, and CP 75, which is a document request related to specific items on your return. Every IRS notice has a response deadline printed on it. If that deadline has passed, the issue has not resolved itself. It has escalated. Contact a tax professional immediately if you have any outstanding IRS notices that have not been properly responded to. Now let me cover the specific forms that are relevant to these issues, because knowing what forms are involved will make your conversations with professionals much more efficient and will help you understand what you are actually dealing with. Form 709 is the gift and generation skipping transfer tax return. This is what you file when you give someone a gift exceeding the annual exclusion. Transferring a partial interest in real estate absolutely counts as a gift. Many people assume gift tax only applies to cash. It does not. Real estate, stock, and other assets all count. If you added a family member to your deed and the value transferred exceeded $18,000, which it almost certainly did if your home has appreciated, Form 709 should have been filed for that year. Schedule E is Supplemental Income and Loss. This is the form where rental income and expenses from residential property are reported. If you have been renting out any part of your home and there is no Schedule E on your returns, that is one of the most common flags the IRS's matching systems are currently identifying. Form 8949 and Schedule D are the capital gains reporting forms. These are used when you sell a property or a partial interest in one. Errors here typically involve incorrectly calculating basis, either paying too much in taxes because improvements were not properly accounted for, or triggering penalties because the gain was misreported. For inherited property, the relevant document is typically the estate tax return, Form 706, which should have been filed by the estate at the time of inheritance, and which establishes the stepped-up basis for all inherited assets. If you inherited property and no Form 706 was filed, or if it was filed but did not properly value the inherited property, you may have a basis documentation problem that needs to be corrected with professional help. Now let me spend a moment on the emotional reality of this situation, because most financial content skips right past it, and I think that is a mistake. Many of the seniors caught up in this enforcement expansion are people who did not do anything intentionally wrong. They made decisions about their homes, adding a child to the deed, renting out a spare room, taking out equity to cover medical bills, that felt completely normal and reasonable at the time. Nobody sat them down and said, by the way, this specific action requires this specific IRS form, and now they are facing penalties for things they never knew were violations. That is genuinely unfair. It needs to be said clearly, it is unfair. But fairness is not a defense with the IRS.